What if I told you the world is already in the middle of a global financial reset, and almost nobody has noticed? Not because it's hidden, but because it's happening in slow motion. Quietly, structurally, mathematically inevitable. Governments keep borrowing, central banks keep printing, markets keep inflating, and ordinary people keep wondering why everything, food, housing, energy feels more expensive every year. But here's the mystery. If every nation is drowning in record-high debt at the same time, who exactly is on the other side of the ledger? And what happens when the world reaches the point where debt can no longer be repaid, rolled over, or ignored? This is the story of the global debt reset, a slow-burn economic shift that has already begun, a shift that will reshape nations, currencies, and the future of money itself. Stay with me, because the deeper we go, the clearer it becomes that the crisis ahead didn't start with politics, or pandemics or inflation, but with decisions made decades ago that have now chained the entire financial system to a single outcome. To understand the reset already underway, we need to go back to the moment the modern debt machine was born. Not 2020, not 2008, not even the 1970s inflation crisis. The real beginning was August 15, 1971, the day the US dollar stopped being backed by gold. President Richard Nixon called it temporary. It wasn't. With gold removed, money became an idea, a promise, a liability created by typing numbers into a banking system. From that moment on, nations discovered a dangerous new freedom. They could borrow. Forever, central banks could cut interest rates to stimulate growth. Governments could fund wars, welfare, subsidies, and programs without raising taxes. Corporations could leverage, consumers could take on mortgages, loans, credit cards. Money creation was no longer limited by gold, only by confidence. And this was the first twist. Inflation didn't just happen, it was designed into the structure of the system. But here's where the danger begins. Once a nation starts using debt to fund economic growth, growth becomes impossible without more debt. And that sets the stage for the crisis we're entering today. After abandoning gold, governments leaned heavily on borrowing. But the real explosion came with financial globalization in the 1980s and 1990s. Capital could now flow freely across borders. Banks became international lenders. Institutions like the IMF and World Bank offered loans to developing nations. Europe built a shared currency. China opened to foreign investment. The US deepened its dominance through treasury debt. By the early 2000s, a new model had formed. Countries borrowed to grow their economies. Banks lent more than they could ever repay central banks. Cut interest rates whenever markets struggled, and consumers were encouraged to stimulate the economy with spending. Debt was no longer a tool, it was the system. And like all systems built on credit, it relied on one assumption, that tomorrow will always be bigger than today. Because only if economies grow can debts be repaid. But in a world with slowing growth, aging populations, geopolitical fragmentation, and rising costs for energy and resources, the model breaks. And that leads us to the next chapter. From 2000 to 2020, global debt didn't just increase, it tripled. Governments, businesses, and households borrowed at an accelerating pace, far faster than global GDP. Then came the 2008 financial crisis. The system should have reset then. Bad debt should have been allowed to default. Banks should have failed. Governments should have faced restructuring. Instead, central banks slashed interest rates to zero and printed money to bail out failing institutions. Debt didn't decrease, it exploded higher, and the world learned a dangerous lesson. No matter how big the problem, central banks will print the money. This was the second twist. A system addicted to debt can never withdraw from it. Then came 2020. Lockdowns, stimulus checks, quantitative easing at historic levels, global supply chain shocks. Governments printed so much money that inflation surged worldwide, something economists believed couldn't happen again. But this wasn't a bug. It was a symptom, a warning. Today, the world carries over $300 trillion in debt, more than 3 times the size of the entire global economy. To put it simply, the world owes more money than it can create productive value for it. And here's the part most people miss. As interest rates rise even slightly, the cost of servicing government debt becomes unsustainable. Countries like the US, Japan, Italy, France, and the UK are already spending record amounts on interest payments alone. Some nations now spend more on interest than on education, healthcare, or infrastructure. This isn't politics, it's math. We've reached the point where debt can't be repaid, it can't be reduced, it can only be reset. But how do you reset global debt without collapsing economies or sparking revolutions? History gives us 3 answers, and none of them are pretty. The first method is inflation. Governments allow the value of money to decline. Debts become easier to pay back, but savings lose purchasing power. The second method is currency debasement, replacing, redenominating, or digitizing money. Think CBDC's digital yuan or a future digital dollar. The third method is default or restructuring, where countries fail to pay their obligations. Creditors take losses, and financial institutions face massive hits. We've already seen this in Argentina, Lebanon, Sri Lanka, Pakistan, Turkey, and parts of Europe. The reset is not a single event. It's a process unfolding at different speeds in different countries. But the outcome is always the same. The old monetary system becomes too unstable and gets replaced with a new architecture that benefits those in power at the expense of those who trusted the old rules. Every major economic institution is aware of this crisis. Their solutions: raise interest rates, lower interest rates, print money, stop printing money, expand lending, tighten lending, stimulate spending, reduce spending, These contradictory policies prove one thing. There is no policy that can fix a system that requires infinite growth on a finite planet. Economists aren't solving the problem, they're delaying the collapse. Governments aren't reforming the system. They're extracting as much value as possible before it breaks. And central banks, they're preparing for the next monetary era. Look around. The patterns are repeating. The US hitting $34 trillion in debt. Japan spending 45% of its tax revenue on interest. China's real estate market collapsing under trillions in hidden liabilities. Europe struggling with unsustainable debt in Italy and France. Emerging markets defaulting at the fastest pace in 40 years. Global interest payments hitting record highs. These aren't isolated events. They're symptoms of a global reset already underway, and the world's elites know it. That's why financial institutions are quietly warning about restructuring, new monetary architecture, digital currencies, and post-dollar systems. What looks like chaos is actually the early stage of a planned transition. So, what does all this mean for you? First, inflation is not an accident. It is a policy. Governments will devalue money long before they admit bankruptcy. Second, debts that cannot be paid will not be paid. The reset won't be announced, it will be felt through inflation, currency changes, and restructuring. And third, the real power in the next financial era belongs to those who understand the system, not those who simply trust it. The global debt reset is not a future event. It's happening right now. And the only question left is, will you be a spectator? Or will you understand the system well enough to protect yourself? If you want more deep dive videos about global debt, monetary history, and the mechanics behind financial crises, hit subscribe, turn on notifications, and share this video with someone who still thinks the world's financial system is stable. Because the reset is already here. And the more you understand it, the better prepared you'll be for what comes next.